Well, hello, folks, and welcome to the Benjamin Z. Miller Investor Networking Group. We have a fantastic presentation we're going to be doing today. We're going to be talking about the exciting world of net lease investing. This is an area of commercial real estate that can offer some long-term passive income. And it has a lot of benefits, but it's often not so well known by most new landlords. So we'll kind of go ahead and go through how all of that works in this presentation. So what exactly is net lease? Well, let's imagine that you're in the United States and you see a Walgreens or maybe a CVS drugstore, those buildings. Interestingly, those buildings are often owned by private landlords. So even though Walgreens is there or CVS is there, they don't own the building. Instead, they rent the building from a private landlord, someone like you or I. And the advantage is when you've got Walgreens or CVS as one of your tenants, they have a very good probability of paying the rent on time, unlike what you might have with a residential tenant where the income stream may be less dependable. If Walgreens or CVS signs a lease, it's highly, highly likely you're going to get paid on time. So there's different types of net leases, and there's all sorts of advantages to this sort of investing. But basically, there's what's some different factors that come into play. So there's a cap rate. You'll often hear that term, which is just the net operating income divided by the price of the property. So let's imagine that a property produces, say, $50,000 a year in net operating income. And let's say that the price to purchase that property is $1 million. Well, the cap rate on that would be 50,000 divided by 1 million. That equals 0.05, or it's 5% or 5 cap. That's what it's called. And then you also have let's say that same property produced 100,000 in net operating income, and it also cost $1 million. In that example, it would be 100,000 divided by 1 million would be it would be a 10 cap, a 0.10 rate. So generally, more desirable assets have lower cap rates, and less desirable assets usually have higher cap rates. So you'll often see this. So to put this into perspective, if you're talking about a quality tenant like Walgreens, the cap rate right there might be somewhere around 5. Whereas if you talk about a package of maybe rental properties that are, say, 20 different single family homes, and let's say it's in a bad neighborhood, maybe a ghetto or a war zone, the cap rate there could be much higher. It could be a 15 cap rate. And so even though it theoretically produces a lot more income, there's a number of disadvantages to that sort of a cap rate. So you don't want to get confused by chasing a high cap rate. That can definitely be a huge, huge problem, chasing a high cap rate. So what about, there's also another term that you're going to hear called credit and non-credit tenant. So credit tenant is when you're talking about a large, powerful company like Walgreens or CVS, they are classified as a credit tenant. Whereas if you talk about, a tenant that's just a little plumbing company and they're going to rent one building, that's a non-credit tenant. So credit tenants, of course, are far more desirable in the net lease world, where if you have a credit tenant sign a lease, it's going to increase the value tremendously compared to a non-credit tenant. And we'll go through that in an example a little bit later. But these are things that are important to know about this terminology. So here's some typical cap rates. This is kind of a sample of what you might see. If you talk about retail tenants, you'd be looking at somewhere between maybe 5 and 7 would be typical. And if you're in, fast food restaurants, you might see 5.5 to 7, something like that. Of course, it varies a little bit, but gives you sort of an idea on what the rates are going to range from. So what exactly are some other things that are important? Well, there's different categories of net lease. You may sometimes hear terms like single net, double net, triple net, or you can also hear a term absolute triple net. That's also called a bond lease or a hell or high water lease. So a single net lease, that is where the tenant is only responsible for paying the property taxes. So even though you own the building, the tenant on a single net lease is responsible to pay the property taxes, but that's the sole extent of what they're responsible for. Then there's a double net lease, and with a double net, if you have a building and you've got a tenant renting it, the tenant is going to pay the property taxes for you, and they're also going to pay your insurance premiums. And then finally, there's the triple net where the tenant is going to pay you the taxes, the tenant's going to pay you the insurance, the tenant's also going to be responsible for most of the maintenance. On a triple net lease, the roof may not always be included in that, but it sometimes is. So it just really depends. And then you've got the absolute triple net or the bond lease or the hell or high water lease. And this is an interesting one because the tenant is responsible for all of the expenses and repairs relating to the building, including the roof and the structure, the taxes. They're responsible for everything. And if the building were to burn down, the tenant is still responsible for paying the rent in that sort of a lease. So it's a very interesting lease. How do net leases compare to, say, investment grade bond yield? And bonds are a great investment. They're something that every portfolio should have, especially if you're looking at corporate income bonds. Those can be really beneficial. But net lease, in some cases, can be comparable to what you would see on triple net cap rate. It varies a little bit. And this is, of course, just a sample to kind of show you an idea. But you might see an investment grade bond yield that's maybe around 2%. And then you could see in some cases a triple net cap rate, it could range somewhere maybe 6, 7%. But the difference is if that commercial asset is purchased with financing, at the end of the term, the mortgage can be greatly paid down. And if the lease is extended several times, it can be paid off. There's a lot of big, rich, powerful companies that do net lease. Walmart loves to, so does CVS, Target, FedEx. They all love net lease. And that is because even though they have the money to buy the real estate, they prefer to focus on their core business, because investing in these sorts of assets at the retail level, you might be getting 8%, for example. Maybe you're getting a 6, 7, 8% rate of return as the landlord, whereas these companies can get higher rates of return on their core business, so they try to focus on that. So here's an example of a high quality tenant. This is a McDonald's, and it's got a 3.85% cap rate. Look at how low that cap rate is. So that means that if you were to purchase this, you'd be looking at at $63,872 in income that you would get. You multiply the cap rate by the purchase price. If you buy the building, you could expect to receive $63,872 annually. You get monthly payments of $53.23. So that's an example there. What about a low quality tenant? I want you to notice here, this has a 25% cap rate. This is a little barbecue building that's for sale in Corsicana. Asking price is $800,000. They're offering a 25% cap rate. Can you imagine that, folks? That's a much higher cap rate. On paper, it looks like that would be the better deal, but you've got to be careful because there's always some risk. It might be that this fireworks stand, I don't know the details of it, but my guess is probably the owner has that fireworks stand, and he's probably offering to sell the building to you, and he'll operate the fireworks stand. And that may work out great if he can pay the 25% rent, which amounts to income of $200,000 a year, and monthly payments of $16,667. But that just looks like something could go wrong. Maybe that business goes and fails. Maybe it's not successful, and then you've bought this for $800,000, and after a few months or a year or two or something, it's out of business and you're out of luck. So here's some examples of how the value changes. Let's imagine this vacant building is available. Someone says, hey, I'll buy this. They look at other vacant buildings that are for sale. Maybe it has a value of $400,000 vacant based on comparable sales approach. Now let's imagine that a non-credit tenant, Joe's Plumbing. So Joe's Plumbing drives in and says, hey, I want this. I'll lease it. I'll pay you $10,000 a month for 15 years. And you say to Joe, okay, Joe, sign the lease. So now Joe has signed this lease. Guess what? The value of your building just doubled. Now it's worth $800,000 on appraisal because it's now producing $10,000 a month in rent. That's great. But what about if some guys in suits came in, maybe Dollar General, maybe they came in and they're also going to pay you $10,000 a month. Well, if Dollar General were to sign a comparable lease, the value might actually go to as high as 1.6 million in this example, because of the fact that you're getting paid if Dollar General is your tenant. So very, very important. It's a reliable source of income. You can get the taxes, the insurance, get everything taken care of. I've got in this presentation, which I'll email out, I've got some examples of net lease, and you can look through some actual deals that I've done. Are net lease deals syndicated? Well, yes, they are. They're quite popular with syndication. They're an attractive asset class. They're mostly attractive to kind of the investors that are a bit older, where they are looking on really reliable income streams. They're also very attractive with institutional pension funds that are looking to get kind of some of the trophy assets, but they're not going to double your money very easily, but they are very safe and secure. So if you're interested in learning more about this, please just send me an email, ben@benjaminzmeller.com, or you can text me at 817-203-4160. If you're seeing this on the internet, we have these meetings every week, and you're always welcome to get in touch. We love to meet new people. Have a great day.